This is Ralph Sass. This is the lecture for Chapter 3. Once again, I'm going to try to do this in two parts. Getting to the point where it might take three, but I'm hoping to accomplish what I want to accomplish in two. So let's go ahead and get started. The purpose of the keeping accounting records, and I'm just going to spend a moment on this, is to keep track of our routine business activities, um, so that we know what's happened. Okay, it's also going to provide us with detailed information about a particular transaction. If somebody comes back to us and says, what happened on July 21st, we can go back and pull the data on July 21st and tell them exactly what happened. Okay, and it's also going to give us a way to measure the performance and efficiency within the company, um, so that we can make, once again, business decisions. What we're going to do is create what we call the ledger. Back early on in this semester, I said we're going to create buckets. What the ledger is the ledger is those buckets. Okay, so when we think of the ledger, think of buckets. And what we're going to do is we're going to create a bucket for each individual account. Okay, and what that account's going to show is it's going to show whenever we increase it or whenever we decrease it. And the entire group of accounts, the entire group of buckets, if you want to think about it, each account is a bucket where we're going to keep information on that particular account. And in total, it's called the ledger. Okay, it would not be unheard of for a small business to have 100 or more ledger accounts, because keep in mind, every account's receivable, every customer that owes me money is going to have a separate bucket, a separate ledger account in some way, shape, or form. So for big companies, it wouldn't be unheard of for them to have, accounts payable or accounts receivable, to have accounts receivable as their big bucket, and then each individual customer to have an individual bucket in there. They could easily have a million different ledger type accounts under something like accounts receivable, what have you. So going back to my chapter 1 idea, what have you, with my checking account, is what we're going to start doing is creating buckets for each of the various bills I have, accounts, whatever, um, for my business. So I'm going to have one for utilities, and utilities may have one for electric. It may have a different one. It should have a different one for gas. It should have a different one for water. It should have a different one for telephone. So all of a sudden, right there, just covering some basic utilities, I've got 4 different ledger accounts. Okay. What we're going to do is we're going to put this in what we call a T account. And for those of you that will have me at some point in macro, we're going to use these T accounts when we take a look at the um, Federal Reserve, whatever. It's going to have the title of the account, cash, accounts receivable, whatever. And it's going to have a left side, or what we do is we call it the debit side. So left side is debit side, the right side is credit side. So anytime we debit something, that means it's going to go on the left. Anytime we credit it, it means it's going to go on the right. It does not mean increase or decrease. It depends. And we're going to see how it depends here in a minute. But the bottom line is it depends. Um, Receipts for cash, anytime in the cash account we get cash coming in, it's a debit. Anytime cash goes out, it's a credit. Okay. And all these T accounts will have a balance, and it'll be a balance on the debit side if we have more money coming in this case, or bigger numbers on the debit side. Then on the credit side, other accounts can have a credit balance if there are more credits on that side than there are debits on the debit side. So that's what we're going to do. If you take a look at your checkbook, at your check register, you put all of your withdrawals from that checking account on one side and all your increases to that checking account on the other side. You're really kind of doing the same thing that we're doing here with debits and credits. Okay. Now I don't know if where they put it, but they may have it exactly opposite as far as the checks written are on the left side and the deposits are more on the right side. But that's strictly for make it easier for you to calculate. So debits are on the left, credits are on the right. I told you a moment ago that debits do not always equal increase, credits do not always equal increase, because it depends upon where it falls in our accounting equation. Keep in mind, assets equal liabilities plus owner's equity. All of them have debits on the left, all of them have debits on the left, all of them have credits on the right. But for assets, to get an asset to go up, we debit it. To get an asset to go down, we credit it. But for anything on the right side of that equality, anything over on that side, okay, it's credits for increase, debits for decrease. So debits and credits do not mean increase and decrease. Debits mean left side, credits mean right side. Generally speaking, all assets have debit balances. We're going to come up with a couple of exceptions later on, but for right now, all assets have debit balances. All liabilities and owner's equity accounts have credit balances. Okay, and we call our accounting system what we call a double entry accounting system because every transaction is recorded by equal amounts of debits and credits. You must have an equal amount of debits and an equal amount of credits whenever you're doing a transaction. So let's go back and take a look at some of the transactions we took a look at back in chapter 2, and take a look at what they mean from a debit and credit side. When we bought those 80,000 shares, or really we invested $80,000 to collect shares, okay? Cash went up by 80 grand, and that is a debit, and capital stock went up, and that is a credit for 80 grand. Notice my debits and credits are equal. Next, if you'll recall, I bought land. Okay, when I paid cash for it, my cash went down by 52 grand, so that is a credit of 52 grand, and my asset account land went up by 52 grand. So to get the asset land to go up by 52 grand, I need to debit it. Notice my debits and credits are equal. The third transaction, this brings up a great point. You don't need one debit account and one credit account. You can have one debit and 2 credits, like this particular case. You can have one debit and 20 credits. You can have 20 debits and 1 credit. The dollar amounts must be equal. However, the number of accounts you're debiting and crediting do not. So notice what happened in this case. I bought the building for 36 grand. That's a debit. Why? Because building account is going up for 36 grand. And notice I paid 6 grand in cash, so cash is going down. Cash is an asset, so my asset cash is going down, so I need to credit it. But notice my liabilities, or my notes payable, are going up by 30 grand. Why? Because now I owe somebody that money, and to get a liability account to go up, I need to credit it. Notice my debits are 36 grand, my credits are 36 grand, my debits and credits are equal, even though the number of accounts that I debited and credited are not. I purchased tools on account. Since I purchased tools and equipment are an asset. To get an asset to go up, I debit it. I bought it on account, so I have an accounts payable. I owe somebody some money, so to get that accounts payable account to go up, I need to credit it. Why? Because it's a liability account. So my debit is to tools and equipment, my credit is to accounts payable, and both the dollar amounts are once again equal. Remember, the next transaction is I sold some of the equipment to somebody else because I found that I bought too much. Notice my tools and equipment goes down by $1,800, so that is a credit. And notice my accounts receivable, which is also an asset, accounts receivable, so somebody owes me some money, goes up. So to get an accounts receivable account, an asset to go up, I need to debit it. Now a quick note here about my my balance on my tools and equipment account, it's an asset account. I have a $13,800 debit, an $1,800 credit. So if I took a look in this account, its balance as of right now would be 12 grand. Okay, so it would have a debit balance of 12 grand. Now, what's really going on is what we call journal transactions, and you'll have to do these for the first exam. I've got a handful of them, and this is good form. And usually what we'll do is we'll do these in what we call the general journal. Okay, and when you place a transaction into QuickBooks or Peachtree, this is exactly what you're doing. You will always have the date on the far left. You'll always put the accounts you're debiting first. If there's more than one account, you'll list them first. They're going to go right at the far left. So in this case, when I bought that, when we sold that stock, we debited cash, and there's my debit for cash of 80 grand. And I am crediting my capital stock. I indent, and then I put my credit capital stock, and I put that over here in my credit column. Notice my T account. Wish I could draw straight lines with this thing. My T account is still there, so I've still got those T accounts going on. And owner invests cash in the business. We'll see this with the ledger account too. And this is an explanation. Not all transactions will have an explanation, but many of them might. So that's the explanation for what's going on. One other quick note. Usually, if you were doing a manual system, there'd be one little column here for posting. Okay, and you'll see how that's done here in a minute. And what you would do is you'd put a check mark in there or whatever when you posted it, so you didn't post it twice. Sometimes there are some businesses, in fact a lot of businesses, that use multi-column journals, and they do this because it saves them time and effort. And notice in this particular case, they've got rent expense and they've got debit and credit columns, and so there's their debit, and then their credit is to cash. And so this is how they would do it in a multi-column, and it just saves them on writing all this down. Some of them will only have like a cash payments journal. If you ever take a look at an ad and it says we have a cash payments or a cash receipts person, all they will do is they will give you a multi-column journal, and all your transactions will be either debits or credits to cash. And this transaction down here at the bottom they wouldn't even have. So that's one way to do it. This is a way to do it. This May 25th transaction is a way to do it if you're not debiting or crediting cash. There, my equipment is my debit, and my accounts payable is my credit. Posting is the process of updating the ledger accounts. When we put it into the journal, the ledger accounts are not updated. Now, the beauty of using QuickBooks or Peachtree, whatever, is they are automatically updated. They're automatically posted. In an old school manual system, the reason why we had so many bookkeepers is because this manual system of posting is what exactly bookkeepers were doing. They do the journal entry and then they'd post them to the ledgers. So what would happen, and when we take a look at the ledger, and this is my cash ledger, okay? Once again, I'm going to have a slide that shows this. There's my T account, okay? Debits on the left, credits on the right. This is called a running balance, okay? Because they're always going to keep that balance on the outside. It's going to have the date on January 20th. It's going to have 80 grand, okay, is my debit, and the balance is 80 grand. Now, if this was what I would do is I'd put a check mark in a box there that says that I posted it. And most of the times they'd also have another column here that would be posting. Okay, and what happens is most general journal pages have page numbers, and it'd be like page 1, and I'd put page 1 in there. Okay, and then I would know that if I was looking at the general ledger and I wanted to find out about this transaction, I could go to page 1 of the general journal and find out about that transaction. And since I put a check mark there, I knew that I had already posted that to the ledger account, in this case cash. Once again, capital stock, there's the 80 grand. This is my ledger for capital stock. There's the balance and the credit. Notice I don't have, it's okay to have the balance because I know that capital stock is in owner's equity. And so when I have that balance there, I know that is a credit balance. And I knew that cash was a debit balance. So that's how posting it to the ledger works. Okay. So after we post this particular transaction, notice this was the transaction where we spent 52 grand for cash. Notice what happens in this case. There's my debit of 80 grand for when I put the cash into the business. There's my credit for 52 grand, and there's my balance. And yes, we call this a running balance ledger account. I'm going to stop there and pick it up with part 2 on the lecture for chapter 3 in the next video.